What's going on, everybody? Welcome back to Wolf. It's great to have you all here, joined by Henry Greene from KraneShares, firm known for helping investors access parts of the global markets that a lot of people are actually overlooking. Hopefully with these conversations, we're able to get you guys to see newer areas of the markets, look at the market differently. They've built a great reputation by turning some complex themes like in China, global growth, and other areas in the geopolitical realm into some pretty cool investable ETFs. We're here to break it down, talk about the things that they've got going on. There's some really exciting ones that we're going to talk about today. Henry, welcome to the show.
Hey, Cade, thanks for having me. Good to be here.
Absolutely, 100%. So, we have earnings coming out. There's a couple that are like right over the cusp. One already happened. I'd love to hit on those a little bit as well. But talk to me about a couple of the most exciting ETFs that you guys offer that you found that there's a lot of interest around. People are excited about it, or even ones that are newer that people haven't heard of.
Sure. So a lot of people know us for our KWEB China Internet ETF. KWEB has been around for a long time, and it has become essentially the benchmark for China Internet stocks here in the United States. We're proud to say it is about the largest China ETF here in the US. I think it's neck and neck for the largest China ETF here in the United States. So it's a really great way for investors here stateside to access China's capital markets. That being said, more recently, we have launched a series of single stock ETFs that's 2x levered single stock ETFs for some of the top KWEB names, as well as Mercado Libre, which is in another of our ETFs, KEMQ. So we've launched single stock ETFs on Alibaba, that's ticker KBAB, JD.com, KJD, Baidu, KBDU, and Mercado Libre, KMLI, as I mentioned, and KPDD as well, which is PDD Holdings, used to be known as Pinduoduo in China. So those are some of the top KWEB names that you can actually do this with because they have US ADRs. So we're able to launch 2x levered fund for each of those names. And really why we did this, Cade, was because we had demand from our clients for these type of products. And we are able to provide very current, very in-depth analysis on all of these companies that is of value to our clients who want to trade in these names through a 2x ETF structure. So we're very happy to have come out with those. And we're seeing a lot of pickup in use cases for them. So I know we had some earnings this morning, Cade, and I think we want to talk about that.
Yeah, absolutely. Well, so real quick, right before we hit into that, so you mentioned that is coming from investor interest. They want to see these ETFs come out. They want to be able to invest in them. There's also another sector of investors who look at China and a few of these other areas outside the U.S. as like uninvestable. They're not like sure about what they think maybe. What are they missing that you guys have picked up on, and the investors that are asking for these ETFs are picking up on?
Sure. I think that when you look at the world today, a lot of people are really excited about AI, right? Here in the United States, it's been a key theme, and technology innovation, right? And when you look at, a lot of people think the U.S. is the only game in town for that kind of exposure, and the answer is it's really not, but you do have to look for it in specific places in the rest of the world. And China is a key place where you can find the same technology growth drivers and technology innovation that's very similar to what's happening in the United States. Different in some key ways, which we could get into. But really, when you're looking for international exposure, you're looking to diversify internationally, you actually don't have to give up on those technology growth themes. So we actually help investors realize this and stick with these themes that they believe in and love so much, but diversify a little bit internationally.
Definitely. And would you say that's the biggest misconception with like U.S. investors? I mean, if you're looking at emerging markets, I guess there's all sorts of emerging markets and sectors of the industry that are popping up. Like there's a lot of people who are going to get left behind in the AI and the tech bubble. They think it's a bubble. They're not wanting to participate. And there's like the geopolitical realm. There's like all international stuff that also can be viewed as an emerging market too. Would you say that's like the number one in terms of just like the misconception that the U.S. investors have?
I think it's hard to say what the number one misconception is. I think that's a big one. I think that more than a misconception, it's an assumption that when you look at, like the MSCI Emerging Markets Index, for example, which a lot of people use to track emerging markets, it's broad-based, it's many, many different countries, but it is not tilted towards what we like to call growth sectors, right? It is still a lot of financials, a lot of industrials companies, that are just not going to have the same kind of growth characteristics as even the S&P 500, right, which has become very concentrated in technology names, right? So again, assuming you're a growth investor, right, you're going to want to look at the exposures we have, just because we're very differentiated in that way where we're capturing these growth themes. That being said, I think that there's a big misconception. I think that right now, geopolitically, I think there's a lot of confusion over what's going on between the U.S. and China, right? Yeah. And so, we try to present our perspective, which is a research-based approach, which is based on expertise, like our general counsel, who was Obama's former ambassador to Singapore. And just we have a great knowledge base there. And it's a really chaotic, uncertain world right now, especially with the conflict going on in Iran. And but still, there are very positive. They're actually in this turmoil that's happening in the Middle East. We think there's still silver linings actually for the U.S. and China relationship. And so, yeah, we could dig into more to that, but I think that's another obviously very current, but I think that's something people are misunderstanding a little bit. And a lot of these names, the ones that I've mentioned, the KWEB names, are being sold off in the chaos, right? Yeah. Along with the broader markets in some cases, but a little bit more than the broader markets as well, right? And we really think that that's not really justified by fundamentals or what the actual macro risks are to these names, Cade, because it's pretty minimal when you look at it, however you want to look at it, whether it's China's exposure to oil coming through the Strait of Hormuz, or if it's what are their revenues from, let's say the Middle Eastern countries, right? Any way you want to look at it, these companies aren't really exposed to this conflict, but they're being traded as though they are.
Okay, that's very well said. I like that last part as well. And we were talking about some of the ones going on in China and Asia. Talk to me about the earnings that have kind of caught your eye that you guys are paying attention to most. With Alibaba coming up very soon, what else is kind of on your mind?
So this morning we had Tencent report their earnings for the Q4 of 2025, of course, and it was pretty solid. It was pretty much in line with what most analysts were expecting on both the top and the bottom line. And management was really, really excited about their AI initiatives, putting a lot more funding into AI investments going into 2026. And also they noted a free cash flow increase of actually 6 times. So that's pretty incredible. I think you'd be hard pressed to find a US tech company with that big of a free cash flow increase year over year. And so just doing very well. They're also been talked about integrating more of their various AI large language models into their what are called super apps. So that's WeChat, QQ in China, where people access, if it's messaging, social media, and also accessing local services like ride hailing and banking, financial services. And so they're integrating AI. They talked a lot about integrating AI through their models into these services and how they're moving forward with that. Also, international game revenue for Tencent was very good. Tencent Games actually produces PUBG and a few other games that might be known to people here in the U.S. And so yeah, it was a very solid earnings. It wasn't quite an earnings beat, I would say, but it was very solid. Obviously, continues to be a very profitable business. Continues to see strong growth. Continues to see strong AI adoption and strong AI integration. Again, with that wider ecosystem, right? That's really important, and they've been really executing in that area very strongly. And but you see that the stock. As interesting, Tencent has an unlisted ADR. It's down today. It was up slightly in Hong Kong, right? And I think it speaks to this really jittery market where you can have a strong earnings message, positive message, and it doesn't really do much to move the stock right now.
Yeah, absolutely. I was going to say, we'll see what happens. Alibaba's coming tomorrow. Do you have any expectations for that? How it may react? And then I've got a couple other questions like on the ETF side, but talk to me a little bit about how you're feeling with Alibaba.
Yeah, sure. I mean, unfortunately, looking at what happened with Tencent, I don't know how much stock's going to react, even if the news are really, really good. But it's in the cards, right? For me, what I'm looking at, just as an analyst of Alibaba, what I'm looking at from them right now are two things. One is profitability, making sure they can maintain their profitability because they've been spending a lot on promotion for their local services, kind of instant commerce business. And so I'm looking for that to stabilize, right? I'm also looking to see signs of e-commerce, general their core business, e-commerce, uh, signs of stronger growth in that business, right? I think we know Alibaba's been an AI leader for many quarters now. I think we know that story. That's a really strong story. I think that's going to continue to be a strong story. I want to say, hey, wait a minute, let's look at what is going on with core e-commerce here too, because growth in that has stalled a little bit. So I'm hoping that we can see that growth pick up a little bit. Maybe we'll get it this quarter, so tomorrow. But we might see that in the first quarter, right? I think it was interesting to see in China you had an inflation rate of about 1%, which is the highest in 2 years. Okay, and that's actually a very good thing because it's an economy that had been experiencing deflationary pressure, which weighs on the consumer, which weighs on consumer spending. People don't want to spend money when your money might be worth more tomorrow, right? So I'm looking for that to translate into consumer spending growth, and we would see that in Alibaba's core commerce business. So those are the things I'm looking for with Alibaba tomorrow.
Very cool. Very cool. Well, what other sectors have you found in your suite of options that they have that investors are excited about? Are there sectors that maybe you guys didn't expect to pop off as much as they did? And then I have a part two, but maybe I'll let you answer that one first. I think there might be a bit more too much on that one.
Sure. Yeah. I think that we're seeing really strong. So we have an electric vehicles fund as well, KARS, right? And that's come back significantly. It was down with the second Trump administration, kind of fears on that impacting the EV market in the US because it's a global fund. But we've seen really strong results, continuing strong results from the automakers in China, which form a large part of this fund, right? They continue to export a lot abroad. And so that's been really positive for that fund and that sector specifically. And because one of the fears there was that there was just too much capacity in the market. We did a piece on this. There are 150 car companies in China, right, competing with one another, and they just keep discounting. So it's like you question how anybody's making any money, right? But these companies still continue to do fairly well. I think we will see some consolidation in that industry, but I've been very pleased and in a way pleasantly surprised with the results from those electric vehicles names.
Got it. Very cool. And also, I guess this is going to be the part two. ETFs, a lot of them have exploded in popularity, no doubt, because of some of the thematic ETFs and new ones that are coming out. Obviously, there was like the whole ETF model where people kind of grew up and they hear you just buy this big thing over there and you forget about it, never look at it again. It's not going to move. It's not going to change for a long time. But now, like, things are evolving. There are all sorts of different kinds of ETFs. I'm curious on where you think maybe the ETF model is still underutilized today, if there is anything that comes to mind, and how you think about that.
Sure, Cade. Sure. I'd like to start off by saying there are now more ETFs listed in the United States than there are stocks.
Oh my gosh, it's a wild state.
By a large margin. Yeah. Wow. Okay. So one of the in a way, one of the things that makes my job challenging is because some ETF allocators say, look, I have too many options here. Right? I can go so many different ways with so many different themes and ways to divide up the market through ETFs, right? And so you've kind of seen it. I think you've seen a bifurcation in the ETF market where you have ETFs like SPY, QQQ, right, which are these like very core index-based where like I just want exposure to the broad market, maybe a little bit of a tailoring, but basically just broad market, most efficient, cheapest way possible, right? Okay, so that's one segment of the ETF market, right? And that's probably the largest segment, right? And then the other segment is more high octane stuff. In many cases, stuff that's more high octane than single stocks. I mean, 2x levered single stock ETFs being a prime example of this, right? But also thematic exposures or alternatives exposures, which are both, we're heavily involved in that business as well. And that's been very popular, right? So KWeb, for example, China Internet, right? That's a big theme, big global growth theme that people want to get exposed to, but that requires conviction, right? That's not just saying, oh, that's not a, set it and forget it, as you alluded to, right? Broad market exposure, right? I mean, we believe you should be invested in that for the long term, but no one would say, oh, I bought KWeb and that's a diversified portfolio, right? So, and so it's been really interesting to see this evolution of the ETF industry just in the short span of my own career, to see this evolution happen and be a part of it. Has been really exciting, right? Obviously, we're more on the high octane end of things, right? If you're looking for that broad market, simple set it, forget it, you might think of going to State Street or BlackRock. But what is interesting too, and then in the way it's kind of coming full circle, is we've created model portfolios as well, using our own products as well as some products from a partner. And I got to tell you, it's been fascinating to see our portfolio managers looking at the market and actually developing a pretty well diversified portfolio, using at least 50% of our own products, right? So it's kind of thinking about, a lot of people ask us, well, I really like this product you have, KWeb, let's say it's KWeb. Where does this fit in my portfolio? How much do I put in this, right? Whether that's an emerging market sleeve or broad market. And now we can answer that question, right? And we have this portfolio that we update regularly. It's meant for financial professionals, but if interested, we can check out portfolios.kraneshares.com if there's any interest. So that's been really interesting, and it's been fun to see that evolution. The last point I'll make is ETF. 401k accounts are still primarily in mutual funds. So that's another, I think, the next wave of assets into ETFs could come from conversions from those as well. That's going to be more to the broad market ones, but
sure. Yeah. Wow. Okay, I had that. That's the first time I've heard that. I didn't even. I completely glossed over that. I did not think about that. And kind of gets me thinking, like, how do you think about concentration risk inside some of the thematic ETFs? Like, how do you manage it responsibly? And I wonder if those retirement accounts would begin to shift at all. I imagine they'll remain, pretty low risk just for the nature of them. But how do you guys think about this?
Sure. So, as I mentioned, we started this model portfolios business where we're saying, okay, how can we use our products? We have this product suite, right? How can we use these products as the building blocks for a truly diversified portfolio, right? And we've been relatively successful in doing so with partner products, right? And so that's been really great. Okay, and so the way we think about it is, is like, what is our value add? What is the value add, individual value adds of our products, individually speaking, and then also just of us as a firm and the research capability we provide and the support to our clients that we can provide, and in what areas that is, right? And really the answer is, we can provide meaningful diversification to clients, whether that's international. So in many cases, that's international. I mean, for the bulk of our assets, is providing international diversification, right? And not just the international diversification, specifically through China and emerging markets, right, which are very low correlated to the U.S. market, right? So if you're a U.S. investor, or if you're a European investor, for example, included as well, we have many clients in Europe as well. You're going to get true diversification if you're looking at China and emerging markets, right? And especially with China it has a low correlation than with the rest of emerging markets, right? So one of our thesis statements early on was China is its own asset class. Like it is large enough and differentiated enough to be considered as its own asset class. Okay, out as part of emerging markets, but outside of emerging markets, and the rest of emerging markets is kind of on its own, meaning that it behaves differently, right? And so that was a really powerful idea there, right? That we saw a lot of traction actually with our clients and key allocators. And I think it continues to be true to this day. I don't think it's going to change anytime soon. I think China will continue to be represented an asset class of its own. Again, in terms of its differentiation and size, and of course accessibility, right? So that's been really powerful. And again, it's regardless of what you think of China, right? If you're bearish, bullish, whatever, it doesn't really matter. The bottom line is if you're a global allocator and you don't have a view at all on China, right? You're gonna have some issues.
Fully agreed, and it's a good point. It being less correlated to the U.S. is a really good way to almost force yourself to diversify. And if you're like sitting there, the U.S. markets are melting, for example, and you're just like, good Lord, at least you got that going for you. Yeah. I'm curious how you think about the investor behavior. If you've noticed any changes over the last 5 years kind of thing when it comes to global diversification or diversification somewhere else in their portfolios and things like that. And then if you think there are new ones that have come up as well, like any behavioral changes moving forward that you sort of expect to happen, we'd love to see how you think about that.
Sure. So listen, we are coming out of an historic decade for the outperformance of U.S. markets, U.S. equity markets versus the rest of the world. I think in 8 out of the past 10 years, I got to check that again, but I think in about 8 out of the past 10 years, the U.S. has outperformed everything else by a significant margin, right? And so that's just, it's great. I'm an American. I'm invested here. That's great, and no problem, right? But the question is, when does that change, right? And what do we do about it, right? If it does, and you're seeing a shift, right? I think you're seeing another kind of decade shift if you look at these kind of cycles in decades, right? Because the decade before the past decade, you basically saw the opposite, right? And what else did you see in the decade before that? You saw much higher interest rates, U.S. interest rates, right? So now we're at that time again where interest rates have gone back up to what they were, maybe not exactly, but close to what they were pre-2008, right? Which is, again, when emerging markets did better, right? So we're kind of we're shifting into we're cycling into this decade, right? Mm-hmm. Potentially, right? So I think that right now, capital is very much concentrated right here at home. Right. And that's mainly for other reasons. There's geopolitical tensions play a role, trade tariffs play a role, many factors involved in this. But this U.S. outperformance is a pretty significant reason why so much capital has stayed at home. Right. And I think you're starting to see this influence, have an influence on valuations, have an influence on how information is absorbed by the market. I think when you look at, because a lot of people are saying, okay, well, there's a risk signal in the market when I sell Nvidia, right? Well, where am I going to put that money, right? And it's not even just like money's not leaving the U.S. Even if you want to put it somewhere else, there's only so many stocks. Like I said, there are more ETFs than stocks today. There's also the most valuable companies, like the private companies today, are not going public at the same valuations as they were before. It used to be if you reached a certain level, you would go public, no problem. Now you have companies like SpaceX, OpenAI. I mean, these are potentially worth trillions of dollars, and they're still private. Yeah. Right. Yeah. So so there's really capital feels to me like capital is kind of trapped. Okay. And this has an influence on valuations. I think you're starting a little bit to see it move out again. So out of the United States and also into private markets. That's a very important part of this, and a piece that, and an avenue that we're involved with as well in helping our clients. But I think moving out of the United States, though, is a very important trend you're seeing. I think we saw a little bit of, I think we got a little taste of that last year when you had a declining dollar. And I think we're going to see it more and more.
Yeah, we'll definitely see. And that was actually one thing I was going to ask about. Like, if you guys have a look at the private markets, what kind of things you guys have for investors? Also, just other things you guys offer, things over the horizon that we haven't talked about, or just, I don't know, anything you're able to sort of allude to going into 2026.
Sure. So we have become involved in the private markets in the past couple of years. It was really a decision Looking at, like I said, I think the average company today, I think the age at IPO is like 10, 15 years, right? And then it used to be only like 7. Okay, so companies, suffice it to say, companies are staying private for a lot longer. So we realized that, look, if we're only in public equities, we're really not capturing a lot of all the exposures that we want to, right? Especially in technology, especially in AI, right? We need to actually go into the private markets to do that. So how did we do that? Well, we used so we launched a fund called ticker is AGIX. It's KraneShares Artificial Intelligence and Technology ETF. And that was one of the first ETFs that actually bought private shares in addition to the public equities it holds for the index, right? And in a small weighting, right? Because there's actually regulation change to even allow this. And so we're proud to say we were one of the first to take advantage of this. And so currently we hold in the portfolio shares in Anthropic, and what used to be XAI is now SpaceX,
right?
Known as SpaceX, but includes the XAI. And so that's really exciting. And we've seen a lot of traction with that product. It's a great way to get exposure to a little bit of exposure to these private markets. But again, in an ETF structure, it's super liquid, right? We keep the private. Very importantly, we keep the private exposure at ideally below 15%, about 10%. So you really don't have to worry so much about the liquidity risk there. And we also have a preference in the private exposure. We're actually on the cap table too of Anthropic and now what is now SpaceX and was that XAI. So that's really exciting. Not a lot of there are other funds that are doing this, and they do it through SPVs, and we will most likely use SPVs as well. But we have a preference for that cap table exposure, right? So we think that's very important. If you talk to a lot of institutions who invest in private shares, they'll also tell you that they have a preference for a cap table. I've had many of these conversations, right? And so that's really important. And for AGIX, so it's really this hybrid exposure. And again, we're not trying to. This isn't. We're not a hedge fund. We're trying to accurately define the artificial intelligence opportunity globally, and so we found that the only way to do that is to include these private companies, right?
Yeah.
And we think that that's the best definition. So yeah, that's one way. We've definitely been involved in the private markets.
I was going to say that's very well put, and glad you guys are getting ahead on that. And very cool. That last point there is very cool. What a lot of people are wondering, about the private markets. So I'm glad we got to fit that in because I think it's important. I think it's an expanding market, and like you said, people are able to get some really cool opportunities, companies you before couldn't get involved in. And so I think it's amazing what you guys are doing at KraneShares. Henry, it's a great conversation. I always love having you on and getting an update on what you guys are building and how you guys are viewing these markets. Is there any last things you want to throw in there before we sign off?
Well, thank you, Kate. Thank you for having me. I guess just definitely check us out, KraneShares.com. You can subscribe to all of our research and product updates, as well as you can subscribe to our daily markets note at ChinaLastNight.com.
Very nice. Very nice. We'll have all those links down below in the tweet below this podcast. And if you're watching on YouTube, it'll be in the description. Thank you all to the Wolf family for watching. We'll see you guys all in the next one. Take care, everybody.